Welcome Monday, September 22nd, 2025. Today, I guess I want to jump in on one YieldMax Fund, specifically give like kind of an overview of how it's done and maybe analyze the reasons to potentially own it. So YieldMax, of course, I like to cover a lot of the single stock ETFs it has that pay a pretty good distribution driven by selling calls or credit spreads on a synthetic position. One of which has been performing pretty well lately is GDXY. As you can see it here, fund initiation was in May of 2024. It's currently trading around 17, opened at 20. Been paying a pretty solid dividend in the 3 to 4% range every month. And for a total return since inception date, including the distribution as well as the ETF price currently, it comes in at 30%. So GDXY, what is it? And that's in Group B. Just jumping in here, it of course is built on the gold miners. So it's really tracks the move in the gold price. As you can see, the underlying equity price of GDX has gone from 35, gone parabolic here to 68. Clearly relative to the YieldMax funds, the underlying has been doing quite well lately. It's been outpacing, of course, these YieldMax funds. But for those who are looking for the extra income, the YieldMax funds offer like a secondary alternative. Reinvest your dividends, of course, is doing slightly better than the non-reinvestment approach. But a lot of the gains, a lot of the kind of separation for GDX has just been driven a lot lately by the gold price, which I think everybody's seen has been doing very well lately. But as far as distributions, the GDX has been paying a pretty solid distribution, or pretty standard, or pretty consistent, I think is the word I want to say. Recent's been 64 cents. I guess I don't have the average on here, but you can see it's probably between 50 and 60 cents on a $17 ETF currently, so not a bad entry price at the moment. And then for those who've owned it since inception date, the initial price was 20. It's paid $9.01 thus far, total distribution. I'm currently trading around 17. So you can see, I guess the ETF might be down about $3 per share, but the cumulative dividend's over 9. So I guess you got about a total return there of 6. 6 on 20 gives you about, like I mentioned before, about 30% total return since the inception date, which was been just over a year now. So maybe I should break that down to an annualized rate because that's what everybody relies on. But 30% since inception date, well, maybe I'll add that note to later. But I guess as far as gold, just as a general note, I mean, you can see the overall return here has been pretty stellar lately, 43% in the last year. A lot of it driven quite rapidly since, what I want to say, mid-August. It's 3,300 to almost 3,800. So good overall return. There's a bunch of articles, of course, on Yahoo. Seen Yahoo Finance have one. Gold, what do they say, 40% in 2025, on pace for its best year. Gold was very stagnant for a while, but lately it's been driving higher. The reasons they note, I think most of them, I think the two key reasons, they got the easing cycle coming up. So Fed's looking to cut rates. Cutting rates, of course, expected to increase money supply, or the thought of it, and therefore drive up the price of assets. Gold, of course, being the number one asset as a hedge to inflation, as a hedge to currency risk. So that's driving it. And then I think it also notes in here that just other countries across the world are buying gold to hedge their currencies versus the dollar. And I just, as a note, let's see here, I pulled up. So what's the debt to GDP ratios for the world's largest economies? So clearly in the USA, I got this on my site here. If you go to the US debt, and this is, I guess, in my mind, which is kind of a big investment thesis for both gold, Bitcoin, and really any assets in general that are not dollar-based or really currency-based, any fiat currency. But so the national debt, we got 37.5 trillion, at least according to this source. The second per second accuracy might be off slightly, but this is just in general. But so what is 37.5 trillion? We got a population of 346 million, or 346.2 million. So clearly just doing the math. For each person, I assume this is just in the world, whether they're working or not working, whether they're 1 year old or 85 years old, the U.S. national debt per person is 108,000. Per household, it's 280,000. And that's just the debt that we currently have on the books. If you include the unfunded liabilities, which include Social Security, unfunded liability, Medicare, unfunded liability, prescription drug, unfunded liability, and then even these other ones, national healthcare and unfunded liability, we got a total of basically not 37.5 trillion, but 123.3 trillion, which comes to a per person of 356,000, or almost 900. I'd say that's getting close to almost $1 million per household. Slightly less than that. But yeah, the debt is a problem for the U.S., as I'm sure everybody knows. But not only is it a problem for the U.S., I mean, you also have, so you got basically the USA at 122% of debt to GDP ratio. But all across the entire world, you got Japan here at probably the highest at over between 230 and 240% debt to GDP ratio. France, Europe's also terrible. You got France at 115, Italy at 138. Even to the north of us, Canada is over 100%. Probably one of the better ones in this list of the large economies is Germany at 65%, but still not excellent. And in general, these debt to GDP ratios keep rising, not because the GDP is necessarily going down, just because spending is way out of control, not only in the US, but all across the world. China is noted here as the second largest GDP at 96%, but that's assuming people can trust China's numbers. China always gives numbers that are fraudulent at best. But even on that, so you got the USA, China, basically everybody's approaching 100%, or if not already thrown by 100%. USA's was really driven mainly with that COVID-19 relief that was basically issued out, but never really the typical thing with governmental spending, particularly government spending that's supposed to be temporary, is I think what the famous economists have said, there's nothing more permanent or lasting than temporary governmental spending. Yeah, so overall, what does this drive? Of course, this drives gold. So I think you've seen that lately in the prices. But as far as GDX, so GDX is the underlying for GDXY, which is the YieldMax Fund. GDX is the Gold Miners ETF. And so rather than invest in physical gold, you can invest in GDX, which is the gold miners. Why would you want to invest in GDX? Gold miners are basically a levered play on gold because they have their fixed operating expenses. So then when the commodity price that they're actually producing rises, it can really amplify their profits since the flat costs stay flat while the variable costs, such as or not the variable cost, but the variable revenue streams from the underlying commodity can increase and basically hit their profits at a levered rate relative to the underlying physical asset price of gold. And then they say too, I guess this is Claude here, that gold miners are undervalued relatively to gold right now. So there's a gold miners to gold ratio that's been tracked for years. It's generally cyclical in nature, and they say right now this ratio is low, which signals that mining stocks might be undervalued relative to the underlying commodity, which is then another boost when you consider the underlying commodity could be going up in price as well. So I guess that's just a general thought process for GDX. But jumping back to the YieldMax Fund, just taking a look at GDX, which is in Group B. For those who are interested in GDX, of course, it's not the underlying commodity. It's a play on it that they basically create a synthetic position in GDX, but then sell calls against it. So exactly how this fund is structured. For those who are interested in exploring it or own it currently, you can see that currently they got a synthetic price set at 66. So GDX is currently at $73.54. So a little bit higher than this stock line here. But they basically buy a bunch of calls, sell a bunch of puts to basically give them virtually the same exposure as owning GDX. Just they do this through a synthetic approach using calls and puts. It's currently set at 66. That doesn't really matter necessarily. They got the same exposure to the stock as you would if you held the shares. Just if you look at it from a fund perspective, that synthetic currently has $1.53 a share in value because the price of GDX is higher than what the synthetic strike price is set at the moment. But yeah, I guess currently you can see they got the synthetic structured. They sold calls, which expire 9/26/2025. Most of them are sold at 72 and 73. That said, they also got calls bought at 74 and 75. So basically what they're looking to do is they're looking to generate premium by selling these calls. However, if the stock price of the Gold Miners ETF really runs, they also got calls bought at 74 and 75, so they capture some of the upside if there's a big move. You can see in this case, it was a good choice for this week because we already have GDX price has gone beyond the strike prices of 72 and 73. So I guess if it keeps running, we hopefully start to capture upside again because of the calls that we have bought. As far as how they're using their synthetics, so you can see those calls that they have bought, they currently represent, or all the calls they have bought on 74% of what they have sold. So if you really got to run in GDX, once you buy the calls that are bought, we're going to be capturing upside at a relative ratio of 75% of what the GDX underlying equity would capture. So that's the purpose of that fund, of that metric here. But yeah, I overall just wanted to cover GDX. I've got all the data as far as what the fund holds, how it's made up. You can see it's relatively a little higher than this right now, but it's about 17 a share. But basically the fund is made up of a cash position, synthetic position, and then the other contracts that it has sells on a weekly basis to generate basically weekly option premium that they pay out once a month. So you can see that's currently valued at a negative 20 cents per share right now as of this morning, and they'll use that to pay their distributions going forward. As far as how the fund's performed, I track kind of the metrics. I basically track these metrics. So you got the ETF price, which is basically the sum of the cash, the other contracts they have sold on a weekly basis, and then their synthetic position. These three added together equal the ETF price. And you can see that right here too. You got the ETF price and their cash position, which has recently elevated quite a bit and went from $12.90 per share to $15.65. Basically, because once that synthetic generates a lot of not premium, but value, they can rewrite the strike price to a higher strike price and basically cash that in. Looks like they did that here, boosting their cash amounts considerably. And then since then, the synthetic continues to rise. If you're bullish on gold prices, GDX might be a good investment. GDXY might be a good investment for YieldMax, of the YieldMax funds, to assist with those looking to increase their monthly premiums or monthly distributions that they receive. But yeah, that's an overview of GDX. Once again, it's the YieldMax Fund, focus on the GDX or the Gold Miners ETF. And once again, here's the distributions you're looking at since inception, which was in May of 2024. They've paid a pretty consistent dividend that has totaled out to $9.01. So assuming the $20 initial investment, somebody's approaching getting half their money back thus far for those who have invested since May, June of 2024. I guess the first distribution was actually paid out in early June. So you could have been an investor anytime before or from the inception date till the ex-dividend date to get that first distribution and the cumulative distribution of $9.01. Anyway, that's a quick update on GDX. Thanks.